This video will look at consolidation with an asset revaluation 1 year after acquisition, where there is goodwill on consolidation. In this example, on 1st of July 20XO, Michael, an investor, acquired 100% of Samuel's business ownership for $500 million. At the date of acquisition, Samuel's business had 200 million share capital, 280 million retained earnings, and that was represented by machinery cost 533 million with accumulated depreciation 53 million. So 533 less 53 million equals 480 million carrying value. Michael determined that machinery's fair value was 490 million, with no change to its remaining useful life and no residual value. Michael had issued 500 million in share capital, which was used to purchase Samuel's business. Investing firm is Michael parent and the invested company is Michael subsidiary. Michael parent and Michael subsidiary provided the income statement and the balance sheet as of 1st July 20XO, that's at the date of acquisition, and at the end of 30th June 20X1, that's 1 year after. On 30th June 20X1, Michael parent determined that goodwill on consolidation was impaired by 2 million. Corporate tax rate is 30%. Required on 30th of June 20X1, 1 year after, show consolidation entries and show Michael Group financial statements. At the date of acquisition, the financial statements of Michael parent shows that there was a share capital issued 500 million and that became an investment. Michael subsidiary shows a share capital and retained earnings of 200 and 280 million. That's represented by machinery after accumulated depreciation equaling a carrying value of 480. There were no activities in the income statement because that's at the beginning of the year. 1 year after, the financial statement shows that the issued share capital of Michael parent is 500 million and the investment is 500 million. Michael parent is a passive investor that was invested to take voting rights in Michael's subsidiary. Previously, it was Samuel's business. There was 200 share capital and 280 retained earnings. The machinery is 533 cost. The accumulated depreciation has increased by another year. So 533, and at the date of acquisition there was 53. So to come to 53, there has to be a number of years upon which it's depreciated, and it equals 10 years. So 1 year of depreciation at the date of acquisition, there are 2 years of depreciation and the first year after acquisition. The net assets of Michael subsidiary 580.03 equals shareholders equity 580.03. Michael subsidiary actively operates and has made profit after tax. Our first journal entry that we need to do is to revalue the asset. So to revalue the asset, we must find the carrying value of the machinery. To do that, we debit accumulated depreciation and we credit machinery. By doing that, at the date of acquisition, the machinery cost account then shows the carrying value of 480. Is now being revalued by 10 to bring it to 490 and debit machinery cost and we credit revaluation surplus. The increase of the carrying value compared to tax base is the taxable difference, and applying the tax rate, there's deferred tax liability of 3. And that's debited to typical income statement, but because it's an unrealized gain, we debit to revaluation surplus. That's the first journal entry. Now that we have found how much is the revaluation surplus, that's 10 less 3 equals 7. We can now eliminate the investment against shareholders' equity. Shareholders' equity of the subsidiary should contain revaluation surplus, which was not there because Samuel has not revalued the asset. Now that we have done it, I will bring it here for the elimination. So we credit investment in machinery and we debit share capital 200. It's 100% acquired. And we debit retained earnings at the date of acquisition 280. And revaluation surplus 100% and 7. That results in a debit amount, which is the goodwill on consolidation. The excess or the revaluation is 10 million. So if we look at the cost and the carrying value, the tax base was 480 on 1st of July 20XO, and the carrying value should be 490. So the taxable difference is 10. And applying the tax rate, deferred tax liability is 3. So in our first journal entry, we credited deferred tax liability 3. During the year, because the carrying value is 490 and 10-year useful life, the depreciation expense should have been 49. But the asset is held at 480 in the subsidiary. It has been depreciated over 10 years and the depreciation expense is 48. The difference is 1 million, and that is additional depreciation expense to be included now. And the carrying value at the end of 30th June 20X1 is 441. Tax base is 432. The difference between the two is 9 taxable value. Applying the tax rate, deferred tax liability is 2.7. So the difference between the two is 0.3. So that 0.3 is the 0.3 debit. And we credit income tax expense because the asset has been now used up for a year. The depreciation expense of 1 million is now debited as a consolidation entry that increases the accumulated depreciation. So that's our third entry. Our fourth entry is to include the impairment of goodwill, and that's 2. And the accumulated impairment on goodwill is 2. So we've done the consolidation journal entries. We must now include them on the consolidation worksheet, which has MICA parent and MICA subsidiary, and then it has debit and credit adjustment columns, and then finally the group. So in our first journal entry, we debited the accumulated depreciation and credited the machinery. Then we revalued the asset by 10, debiting machinery and crediting revaluation surplus 10. The increase in carrying value in relation to the tax base is the taxable difference, and applying the tax rate gave the deferred tax liability 3. The debit side of that is typically income tax expense because this is an unrealized gain or unrealized asset. The amount is now debited to revaluation surplus. Our second journal entry is to eliminate the investment against the shareholders' equity at the date of acquisition in the subsidiary. The investment was 500 million. We credit and we debit the shareholders' equity of the subsidiary at the date of acquisition in the adjustment columns 200, 280 for retained earnings, and the revaluation surplus 7. The difference between credit and debit requires an additional debit, and that debit is the goodwill on consolidation. Because we increase the asset value by 10 due to revaluation, there should be additional depreciation to top up the depreciation to match with the revalued amount. So the excess is 10. The useful life is 10 years, and therefore the accumulated depreciation and the depreciation expense is 1. So in the current period, we debit for the depreciation expense 1, and that increases the accumulated depreciation of 1. When we increase the depreciation expense, the profit decrease. When profit decrease, the income tax expense decrease. That's by 0.3. So we credit 0.3. That 0.3 is debited to deferred tax liability because the asset is been used up, and the carrying value keeps dropping. Therefore, the deferred tax liability correspondingly decreases. The fourth journal entry is about the goodwill impairment. Debit the income statement too, and we need to credit into a newly opened accumulated impairment on goodwill for group accounts too. Once we have done, we can add the rows across, keeping in mind some accounts are debit accounts and some are credit accounts, and then there are adjustment columns of debit and credit. We see that goodwill on consolidation is 13 in the group, and there's machinery. The revalued amount is 490. And there is accumulated depreciation 54, which includes for the revalued amount. Because the subsidiary was active in generating profits, it has increased its cash position, and the net assets are equal to 597.33. In the shareholders' equity, because we eliminated the subsidiary share capital, the share capital in the group is the parent share capital. And the prior year, that's at the date of acquisition, the shareholders' equity of the subsidiary is eliminated. What's remaining is after the acquisition or the post-acquisition profits of the subsidiary, which is 100 after the adjustment amounts, and that's 97.33. And the shareholders' equity is 597.33, which match with the net assets. So the group's net assets and shareholders' equity are Michael Parents Group, which is for the Michael parent to benefit. The income statement, Michael parent is a passive investor, has nothing there. Michael subsidiary actively operates, and the financial statement shows it has made a profit. But in that, there are consolidation adjustment entries included for depreciation, the excess depreciation that should be included, and then the tax expense, because it increased the expenses, so therefore income tax expense decrease. And then other expenses, which is the impairment expense of 2. The impairment expense is considered as not taxable, so therefore it has no impact here in the income tax expense. So the group finally has made 97.33 million of profits. That brings us to the end of the video. Thanks for watching.